Hello and welcome to Module 25. Our topic is mortgage lending and predatory lending. As I had mentioned in the last module, mortgage lending is always a big area of concern, both with Congress and with the regulators, because of its importance to our economy, as well as the importance to the individual citizens and the individuals who are trying to get the mortgages. We had, I guess what everyone might say, a bit of a mortgage crisis in 2008, or at least the financial crisis in the United States was attributed largely to problems in the mortgage industry and what was going on with mortgage lending. And because of that, the Dodd-Frank Act had a large section that dealt with mortgage lending. It also had a big section that dealt with appraisals. We discussed some of the issues with appraisals in our last module. But it really looked at, what is an appropriate mortgage, and it imposed qualified mortgage requirements and an ability to repay and a risk retention. And some of this may seem kind of interesting, particularly the ability to repay. You would think any bank would want to ensure that the person borrowing money could repay the loan. That seems like you wouldn't have to put that in the law. But one of the things that was happening prior to 2008 was we were getting a lot of sort of new players in the mortgage lending industry, and we were getting a lot of new players in the securitization industry. We've maybe talked a little bit about that, but securitization is when a bank makes a mortgage loan, makes hundreds and thousands of them, and then it bundles them together and it sells them to an investor. And then the investor actually bundles it differently and sells pieces off to other investors. And these mortgages actually ended up being sold time and time again. And this became very, very common in a way that it had been going on for some time, but not really at the level that it was going on in the 2000s. And the other thing that we were seeing was more and more individuals were qualifying for mortgages because there were all kinds of interesting mortgages being offered. There was your 30-year fixed, but there were also, 3-year adjustables, and there were mortgages where you only had to pay the interest for 3 or 7 years, and then you had to finance the balloon, and all kinds of creative ideas going on. But one of the things to know about mortgages is there are a lot of upfront fees, and a lot of people make a lot of money the day a mortgage is made. And then over 30 or 3 or 7 years, there's a repayment, but a bulk of the money is really made on day one. Another thing that this graphic illustrates is that starts with 2001. And what you see here is, first of all, look at the volume in 2003. It's just a record high. And so the good thing is that a lot of people are getting mortgages, people that could never get mortgages. The problem is the default rate is rising. Now, the default rate is not rising nearly as quickly as the number of people getting mortgages, but it still became at record highs. The other thing to note is that the green is the private securitization, which you see in 2004, 5, and 6 becomes very large. And the blue is when the lender actually holds the mortgage, and that is becoming, you see, very small. And so the purples are the government securitization, which has been going on for a long time. And we actually see in 2003, there's a tremendous amount of government securitization. It then drops as the private sector seems to step in. But then what we see after the financial crisis of 2008, the private securitization is basically gone. Now, this only goes to, I believe it was from 2019, and the private securitization is increasing, but it's still nothing like it was, in 2004 and 2005. So this, I hope, gives you a little bit of an idea of how different things were at this time. As someone who is an attorney that works in a compliance capacity, I will tell you, the kinds of mortgages I was seeing, the kind of advertising I was seeing was really unprecedented. Mortgages where you didn't have to show any documentation and you really only had to make payments when you wanted to. Well, apparently that's a very bad idea. So we now have in federal law minimum standards for mortgages. And one of them is that the creditor must make a good faith determination based on verified and documented information that the consumer has the ability to repay the loan. And that also must take into account taxes and insurance and any assessments if it's a condo kind of situation. Because apparently that was another piece that individuals were not understanding, that they had to pay taxes and insurance. And if you have bad credit or if you borrow a large amount, you can have to pay PMI, which is a mortgage, kind of an insurance on your loan. And so a lot of folks were only being told what their mortgage payment was, and they may have a payment almost equal of taxes, insurance, and assessments. So there is now in federal law for mortgages a legal requirement for the lender to document the ability to repay. Now, although that may seem obvious and reasonable, there actually is a way to avoid that requirement, which anytime you have to keep documentation, it can be a risky business. And that is that the lender is making qualified mortgages. Anytime a lender is making qualified mortgages, they are presumed to have met the ability to repay requirement, even if they don't have the documentation. So needless to say, many lenders now choose only to make qualified mortgages. And the qualified mortgages have to have certain features. One is that they have relatively low points and fees, 3% or less. We were seeing a lot of mortgages with 8, 9, even 10% of fees, 10% of the principal amount, no negative amortization, no interest only payments, no balloon payments. All of these were things that would get borrowers into trouble. They would take out a mortgage, they would make really minimal payments, and then 3 or 7 years later, they had to refinance or pay off the whole thing, which they couldn't do, and houses went into foreclosure. And also the maximum term is 30 years. 30 years is a very long time, and we really don't want mortgages to be longer than that. So this kind of brings up what I think is an interesting issue and why we are discussing in this module both predatory lending and mortgage lending, is that what is a predatory loan versus what is an appropriate loan for a subprime borrower can be a gray area. When we get into qualified mortgages and we get into some of these increased requirements we have in the law now, we see the number of individuals qualifying for mortgages drop dramatically. So we don't have the situation we had before with a lot of bad, risky mortgages and high default rates, but we do have the situation where fewer people are able to get a mortgage. And so, like so many things we've talked about, we really have somewhat of a balancing act. What is the appropriate amount of protection to put into the law so that people are able to get mortgages, because it can really be a way to accumulate wealth and to avoid just paying rent and not having anything to show for it, but at the same time getting someone into a mortgage they can't pay is really negative. And so it is a challenge, and it's hard to know if we've reached the right balance. Another part of Dodd-Frank is this risk retention or skin in the game that basically says if a lender is going to be selling the mortgage loans on the secondary market, that's the securitization that we talked about, they must retain 5% or meet one of the exemptions, which again is making these qualified mortgages. So you see there's a real push to get lenders to make these qualified mortgages because then they can sell them all. And the vast majority of mortgage lenders nowadays make qualified mortgages and they sell them all. And so I ask here, why do they want them to retain 5%? And the reason is that if you're making, they're making thousands of mortgages, you want the lender to be considerate or be taking into consideration whether these loans will be repaid. If you sell all your mortgages, there is a fear that all you care about is origination and ability to repay will not be taken into consideration. So it's a big issue, and it really permeates all consumer lending, because this also occurs in unsecured lending and automobile secured lending. There's not any legal requirement, but for other reasons, such as true creditor, this 5% is sort of a standard. But as I said, the law does permit the 5% to, be ignored if the loans meet the qualified mortgage. But as you can imagine, to get a qualified mortgage, you have to have pretty good credit. So we get back to that, what's the appropriate balance? Some of the reading and the notes I asked you to look at went to this idea of suitability. And that is, do banks and brokers, oftentimes nowadays, most mortgages are originated through brokers. That is actually another thing that changed. It used to be that most borrowers went to their bank and took out the mortgage with a loan officer who worked for the bank. Now, most borrowers go to a mortgage broker who arranges the loan, even if it comes from a bank. And oftentimes there's a fear that the consumer thinks those people are working for them, that they're friends, let's say. And so some individuals thought that they should, by law, be required to have a suitability analysis. But that is not the way that the industry works. That your bank and your broker in a mortgage transaction they're not your friend. It's a business transaction. They're not looking out for you. They are trying to comply with the law, but essentially they're trying to make money. And so there was a question here, is ability to repay a suitability requirement? And the answer to that is a resounding no. Determining that someone can repay the loan does not mean that it is the best mortgage for them. And in fact, there have been documented studies showing that minority borrowers with the same collateral and same credit score tend to pay more, that they are steered toward mortgages that are really not suitable for them. Basically, they could qualify for better mortgages. And so if there were a suitability or even more a fiduciary requirement, your bank or your broker would say, hey, you don't have to pay this much. I got something cheaper for you. Now, they may say that because they want you to choose them, but they're not saying that because they have any legal obligation. And that can be something that is not always clear that customers understand, because these transactions are very complicated. And it is true that the bank and the broker and maybe the borrower have some of the same interest. They want the transaction to go through. They want things to go well, but their interests do not 100% align, because to some extent, getting them in a higher priced product can have financial benefits to the bank and the broker, whereas getting in the lowest priced product has benefits for the borrower. But I don't think we're going to see any change in this anytime soon. So we've been talking about this in the context of mortgages, but there's also something that sort of the regulators, as well as Congress and just society, consumer advocates struggle, which is sort of the other end of the lending spectrum, and that is the payday loan, the $100 loan. One of the problems that we've seen in the modern world is that banks don't want to make $100 loans. It's expensive to make a loan, even with all of technology. And so they don't typically offer them, although they may offer these deposit advance products. And so non-banks has stepped in. But there are state laws that can regulate them. And so we have seen sort of, somewhat of a dance with the non-banks and the banks, and, serving this underserved market and determining what is appropriate. What is the appropriate cost of lending someone a small amount of money if they have bad credit? And as you see, if people have bad credit, you can typically charge them more, but at what point does it become predatory? Well, we've seen banks increasingly willing to partner with some non-banks who have expertise in this area, but the state regulators do not like this practice. And we've seen them go back and forth. And it's kind of an interesting dynamic because we see them both saying this is predatory and risky, and also this is unfair because you're charging too much. So you can make a lot of money engaging in this kind of lending, but you also may sustain losses. And that's not what the bank regulators like to see. But as we've talked about, because of preemption, the states are very limited in their ability to regulate banks. And as we know, they cannot regulate the interest rate. So what the banks have done is they have partnered with the non-banks with the expertise in partnering with these types of borrowing populations, and then brought their interest rates. But then the regulators call it a rent-a-bank charter. And so there was a case mentioned, it's not a full case, but it's discussed on page 932, where Georgia and other states have now followed suit, but Georgia was one of the first states that was attempting to ban payday lending. And then they saw that the payday lenders were then partnering with banks, and they couldn't prevent the banks from making high rate loans. So they said, okay, bank, we know we can't regulate you, but we're going to regulate your agent or your partner. And your partner cannot assist with a loan that exceeds a certain interest rate. And so while this was being challenged by the bank was examined by the FDIC, and it was advised by the FDIC that they should not be engaged in this activity. Ultimately, they severed the partnership and the case became moot. But this is really an unresolved issue, is sort of the ability of states to regulate bank agents, whether or not it's appropriate for banks to be engaged in this high rate lending. What is the appropriate interest rate to charge a subprime borrower? And really, how do we kind of treat all borrowers fairly? And at the same time, make sure that banks are behaving in a manner that is safe and sound. One of the products that we do see the banks offering, which are not payday loans, but they are these deposit advance products, which are becoming more and more common, which is where when a borrower has sort of a steady income stream from a direct deposit, the bank will give them advanced access to that. And again, we see the regulators expressing concern. So, if the bank is allowing someone to access an expected payday or, payday direct deposit, what if they have been fired in the interim? Or, what if something else goes amiss? Or what if they agree to do it, but then for whatever reason, they don't actually do it, and then the person bounces checks? And so the regulators, while we have things like CRA that encourage the banks to meet the needs of the low and moderate income citizens in their communities, we also have concerns with some of these high rate products or banks partnering with high rate lenders, or traditionally high rate lenders, and now the banks are the lenders. And so this is really an unresolved issue that we have. And as I said, in the mortgage industry, some of these risky, unusual mortgages, we're not seeing them at all. But we are still very much seeing a lot of exploration with banks and non-bank partners, really in the context of fintechs, which we discussed earlier in the semester. So this is definitely an evolving issue that has a myriad of compliance risks, but it's also a real area, I think, for growth and for customer need. So I welcome your questions or discussion. Thank you.